Investing is easy when think rationally about money. Have you ever wondering that why do we make rush decisions if we know that making rational decisions is better? In most cases in our life, it's easier to go with your gut because then you don't have to think about it. In this video I will show you how investing is easy when you're thinking rationally about money. I will start out showing you the factors that are causing stocks to crash so you can understand how to invest incorrectly and stop worrying about a stock market crash. I will also show you the 3 key successful investments that will protect and grow your money even if Wall Street tumbles. Key number 1 is especially strange, but it actually works. Welcome to Investing vs Speculating channel. We make videos, so if that sounds interesting make sure to subscribe and turn on notifications. Now let's get into the video. Factor 1. One important factor that causing stocks to crash is that in most cases individuals' decision-making processes employ emotion in their financial management beyond company reports and market investment analysis. That is, because the rational thinking requires mental effort, and in utmost events the major tendency is people tend to frame things very narrowly. Oftentimes, we delude ourselves into thinking that our economic decisions are rational, finding arguments which fit our narrative and are so compelling that we even believe them ourselves. Factor 2. Second factor is the fear. Actually, the episode of intense fear that triggers severe reactions, or what called as a panic, is a particularly dangerous emotion to investment portfolios. The 2008 financial crisis is often associated with panic and fear. As a result, panic selling is a wide-scale selling of an investment which causes a sharp decline in prices. Specifically, an investor wants to get out of an investment with little regard of the price obtained. The selling activity is problematic because the investor is selling in reaction to emotion and fear. This behavior defined in psychology and behavioral economics as the endowment effect. So, what do economists mean by behaving rationally? Well, according to Friedman Jr., it means that people have objectives and tend to take the correct actions to achieve those objectives. Rational thinking is our ability to draw justifiable conclusions from data, rules, and logic. In fact, at its core, investing is simple. That doesn't mean it is easy, just preserve that the behaviors necessary for success, which are fairly straightforward. By reminding yourself of what they are and always keeping them in the back of your mind, you can improve your odds of reaching financial independence as you amass a collection of assets that create passive income, and also by learning the keys of successful investments. Those things will help you to create the financial future you deserve. Keep watching to learn the most important 3 tricks for successful investments that will protect and grow your money. Number 1 trick. Be rational about price. Imagine you purchased a new home in an excellent neighborhood for $600,000. A week later, someone knocks on your door and offers you $200,000 for the house. You would laugh in their face. Unfortunately, this case are totally different in the stock market. If you face the same situation in stock market, you may be likely to panic and sell your proportional interest in the business simply because other people think it is worth less than you paid for it. In the hustle and bustle of Wall Street, many people forget this basic premise and sadly pay for it with their pocketbooks. Number 2 trick. Invest in assets you understand. To be a successful investor, you don't have to understand fixed income trading strategies, stock option valuation, or even advanced accounting tools. At least, you need to sit down and take an honest look at your entire financial situation, figuring out your goals and risk tolerance. For example, if you are unfamiliar with the insurance industry, don't even attempt to evaluate the performance of a property and casualty company. Sadly, as in surprisingly, many investors ignore this common sense and invest in companies that operate outside of their knowledge base. Pay attention to not put all your faith in financial planning software or survey sheets. Likewise, many investments fizzle out even when they do understand the industry at hand. Financially speaking, what's the best thing to do instead of stock picking that the market is somehow mispricing stocks based on a false notion? You should start by deciding what mix of stocks, bonds, and mutual funds you want to hold, and this decision should be based on your understanding of the company's products, market, competitive strengths, and weaknesses. You may be surprised at what you will find. Number 3 trick. Create and maintain an emergency fund. Most smart investors put enough money in a savings product to cover an emergency. The emergency fund should cover 3 to 6 months worth of realistic living expenses. The best place for your emergency fund is in a liquid account, accounts where your cash is easily accessible. A high-yield savings account might be the best place to keep your emergency fund. To find the right high-yield savings account for your emergency fund, look for options with a competitive interest rate and no monthly fees or balance requirements. Speaking of long-term financial stability, starting an emergency fund is a necessary building block. You know that anyone can do it, you just need the right goals and a plan. So, your emergency fund can continue growing until the day you need it. If you enjoyed this video, then make sure you subscribe and hit the notifications bell so you don't miss a single video.